Good day, ladies and gentlemen, and welcome to your Enservco 2019 year-end earnings call. All lines have been placed in a listen-only mode, and the floor will be open for your telephonic questions following the presentation. If you should require assistance during the conference, please press *0 on your telephone to reach a live operator. At this time, it is my pleasure to turn the floor over to Jay Pfeiffer. Sir, the floor is yours.
Hello and welcome to Enservco's 2019 year-end conference call. Presenting on behalf of the company today are Ian Dickinson, CEO, and Margie Hargrave, CFO. As a reminder, matters discussed during this call may include forward-looking statements that are based on management's estimates, projections, and assumptions as of today's date and are subject to risks and uncertainties disclosed in the company's most recent 10-K as well as other filings with the SEC. The company's business is subject to certain risks that could cause actual results to differ materially from those anticipated in its forward-looking statements. Enservco assumes no obligation to update forward-looking statements that become untrue because of subsequent events. I'll also point out that management's ability to respond to questions during this call is limited by SEC Reg FD, which prohibits selective disclosure of material non-public information. A webcast replay of today's call will be available at enservco.com after the call. In addition, a telephone replay will be available beginning approximately 2 hours after the call. Instructions for accessing the webcast or replay are available in today's news release. With that, I'll turn the call over to Ian Dickinson. Ian, please go ahead.
Thanks, Jay. Welcome, everyone, and thanks for joining the call. Today, we issued our 2019 fourth quarter and full year financial results press release after the market closed. I'll provide a brief review of our 2019 performance as well as some comments on recent macro events and what we're seeing so far in 2020. I'll then turn the call over to Margie for a recap of the numbers. We certainly had a strong start to 2019 after 2 consecutive years of delivering higher revenue and profitability in 2017 and 2018. We reported a 19% increase in revenue and positive adjusted EBITDA through the first 9 months of 2019. Unfortunately, a sharp decline in activity in the fourth quarter offset most of those gains, and we closed the year with revenue up only slightly and positive EBITDA that came in below prior year levels. In addition to the overall decline in customer activity in Q4, we experienced unseasonably warm weather in Oklahoma and Pennsylvania, where demand for frac water heating services fell far off other areas of operations where the weather was more cooperative. It's no secret that the oil and gas industry is facing some serious challenges right now. In Q4, sharply lower drilling and completions activity had already put pressure on us, our competitors, and other players in the oil field services space. Add to that the first quarter decline in oil prices due to the Saudi-Russia price war, coupled with fears of an economic slowdown related to coronavirus. We have all found ourselves in a place that I don't think anyone could have envisioned. To provide further perspective, oil started the year in the mid-60s and is now hovering around the mid-20s. This, in turn, has required us to make, in certain cases, margin-eroding price concessions in order to retain and add customers. Having said all that, I believe it's important to recap some of the good things we accomplished in 2019, because I think they put us in a better position to operate more efficiently once the macro environment turns back in our favor. First and foremost, we grew our market share in 2019, primarily due to our acquisition of Adler Hot Oil Services, previously our largest competitor. We added some new E&Ps to our customer base and closed the year with more customers than we've had at any point in company history. In the process, we further distanced ourselves from the competition as the nation's largest provider of frac water heating services, which are an absolutely critical component in the drilling and completions process. In addition, we took decisive steps to reduce our operating costs. Step 1 was to complete the integration of the Adler acquisition and eliminate redundant costs totaling approximately $1.1 million per annum. Step 2 was the closure of our water transfer business, which was non-core and had contributed $1.2 million EBITDA burn in 2019 alone. Step 3, which actually occurred here in Q1 of 2020, was a further reduction of overhead through the closure of our Oklahoma facility and the redeployment of equipment and several skilled operators to more active basins. To be clear, this does not mean we are abandoning Oklahoma or our customers there. We have a highly mobile fleet and workforce and intend to service them remotely at a lower cost from our larger Colorado operation. On top of the things I've just mentioned, we will continue to evaluate our discretionary spend and implement other cost reduction initiatives that make sense. The closure of our water transfer business allowed us to refocus on core competencies in the areas of production and completion services in order to increase fleet utilization and optimize our fleet deployment. In this regard, we have made investments in process improvement initiatives over the past couple of years that are designed to increase efficiencies and better leverage our expanded fleet and national leadership position. Now more than ever, we recognize the importance of a strong balance sheet. Delevering is and will continue to be a very high priority for us until we get our ratios back in line. Of course, this objective is heavily dependent on a rebound in the price of oil, and right now we have no more visibility to that process than anyone else. In closing, I want to say that I'm proud of and appreciate our administrative and field teams who, despite the difficult environment, have remained laser focused and continue to work hard to provide our customers with a world-class service. And with that, I'll turn the call over to Margie for a review of our financial highlights. Margie?
Thank you, Ian. The fourth quarter and full year results I'll be discussing today reflect the reclassification of prior year results of our Dilco water hauling business and our water transfer segment as discontinued operations. As such, certain year-ago figures will differ from those referenced on past calls. In addition, you probably noticed a new presentation of revenue on the face of our income statement this quarter. We are now breaking our revenue into two segments, production services and completion services. We think this presentation better describes our business and better communicates the fact that we are engaged in both major aspects of our customers' well site activities. Total revenue for the full year increased slightly to $43 million from $42.8 million a year ago. Production services revenue grew 1% year over year to $14.7 million from $14.5 million. Components of production services included hot oiling up 6% to $12.4 million from $11.7 million. Acidizing down 20% from $2.3 million to $2.3 million from $2.9 million. The production services segment generated a profit of $1.1 million in 2019, down $1.7 million in the prior year. Completion services revenue increased approximately $100,000 year over year to $28.3 million from $28.2 million. Completion services generated a segment profit of $7.9 million in 2019 versus a segment profit of $7.6 million in the prior year. Total operating expenses in 2019 increased 6% year over year to $46.6 million from $44.2 million. The increase included higher direct variable costs associated with increased activity and growth investments in South Texas and Wyoming, $1 million in first quarter cost overruns in our since discontinued water transfer business, and higher SG&A and depreciation and amortization expense. SG&A increased 18% to $6.2 million from $5.2 million last year due to an increase in bad debt reserve, higher personnel and overhead related to the Adler acquisition, higher D&O and professional fees, and investments in IT infrastructure. As Ian noted earlier, by early third quarter, we had eliminated approximately $1.1 million in annualized overhead associated with the Adler acquisition. And we're now seeing the benefit of that as well as lower costs moving forward related to other cost reduction initiatives. Depreciation and amortization expense increased 17% to $5.7 million from $4.9 million due to our larger fleet. Our operating loss in 2019 increased to $3.6 million from $1.4 million last year. Net loss from continuing operations, including a $1.3 million gain from the April settlement agreement with the sellers of Adler, increased to $5.3 million from $4.1 million a year ago. Net loss from discontinued operations totaled $2.3 million in 2019 versus $1.8 million last year. Net loss for 2019 increased to $7.7 million or 14 cents per diluted share from a net loss of $5.9 million or 11 cents per diluted share in the prior year. We reported positive adjusted EBITDA of $2.8 million, down from a positive $4.7 million a year ago. Enservco generated $4.5 million in cash from operations in 2019, up from $1.3 million in 2018. Q1 capital spending will be primarily related to maintenance, and for the foreseeable future, we anticipate CapEx to be in the range of approximately $1 to $1.5 million annually. Turning to our fourth quarter financial results, total revenue in the fourth quarter declined approximately 39% to $8.1 million from $13.3 million in Q4 last year. Production services revenue was flat at $3.5 million and included hot oiling of $3 million and acidizing of $455,000, both also essentially flat year over year. Production services generated a segment loss of $116,000 versus a segment profit of $468,000 a year ago. Completion services revenue, consisting primarily of frac water heating, in the fourth quarter was down 53% year over year to $4.6 million from $9.8 million. Completion services generated a segment profit of $404,000 versus a segment profit of $2.7 million in Q4 last year. Total operating expenses in the fourth quarter decreased 17% year over year to $10.5 million from $12.7 million, primarily due to a decline in variable costs related to supporting production and completion services. SG&A expense declined 7% to $1.4 million from $1.5 million last year due to efficiencies we achieved related to the Adler acquisition. Depreciation and amortization expense grew 14% to $1.4 million from $1.3 million due to the increased fleet size. Loss from operations in the fourth quarter was $2.5 million compared to income from operations of $544,000 in the same quarter last year. Net loss from continuing operations was $3 million compared to a loss of $141,000 last year. Net loss from discontinued operations was $340,000 versus a loss of $376,000 last year. Net loss increased to $3.3 million or 6 cents per diluted share from a net loss of $517,000 or 1 cent per diluted share in the same quarter last year. We had positive adjusted EBITDA of $168,000 in the fourth quarter versus a positive $2 million in Q4 last year. On another front, we continue to work closely with our lender, East West Bank, on a potential amendment that would resolve our current over-advanced status. You'll recall that we received a notice of default on our loan agreement in January regarding a fourth quarter over-advance as well as minimum liquidity and fixed charge ratio covenant violations. We had hoped to have made more progress towards resolving these issues by now. However, with the turmoil in commodity prices and global economic upheaval that is impacting the debt markets, the process is taking longer than we had anticipated. More details on this are laid out in our 10-K, and we will keep investors apprised once we have something more to report. Regarding the New York Stock Exchange American listing, excuse me. Since we last updated you on our Q3 conference call, the NYSE American informed us that they approved our plan to regain compliance with their continued listing standard as it relates to stockholders' equity. We have approximately 14 months from now till June 3rd, 2021 to be precise, to satisfy the equity requirement as long as we demonstrate progress toward that goal. We're not able to share further details of our plan at this time, but we will keep you posted on what we can share as the process continues. That concludes our prepared remarks, and now I'll turn the call over to the operator for questions. Operator?
Thank you. The floor is now open for questions. If you would like to ask a question, please press star 1 on your telephone keypad at any time to join the queue. And if you're using a speakerphone, please pick up your handset to provide the best sound quality. Again, ladies and gentlemen, if you have a question, please press star 1 on your telephone keypad at this time. And we'll pause just a moment to give everyone a chance to signal. And our first question comes from Bhakti Pavani with Alliance Global. Please go ahead.
Good afternoon, guys. A quick question. Given the market situation amid the oil price volatility, a number of E&Ps have laid down their drill rigs and halted their drilling and completion activities. So how are you guys preparing, for that, and what kind of impact you have seen on your business, especially in Q1, which is kind of the next highest revenue generating quarter for you guys?
Yeah. Hi, Bhakti. Thanks for the question. So, the laydown and the reduction in drilling completions activity, as we referenced in the prepared remarks, has had an impact on our Q1. As we move into Q2 and through Q2 and Q3, the business relies primarily on production-related activities. And so the reduction in drilling completions work will be less impactful to our Q2 and Q3, but it certainly had an impact on Q1.
Got it. And given the coronavirus situation, which is kind of spreading very rapidly, as a company, how are you preparing yourself, and what precautions you have taken to date? If you could expand on those, please.
Well, we're taking all the appropriate precautions as company policy following the CDC's guidelines. There are little different dynamics between our corporate office, which is working from home, and what we're able to do still from field operations. So our locations are continuing to operate close to normal, paying attention to social distancing, et cetera. But so we're continuing to operate across our locations. We're watching this by the day, by the hour, and staying in close communication with our customers on their policies and any changes to their scheduled work. And so it's an ongoing process of monitoring, but we're following all the appropriate procedures.
Got it. Thank you. You did talk about, closing down your Oklahoma operation. Are there any other operations, across the U.S. that you are monitoring, and you think, you would do similar kind of, thing that you did in Oklahoma? Could you maybe talk about those, please?
I think Oklahoma for us, and we've done this in the past where we provided heating services remotely out of Colorado. So that was an opportunity for us to eliminate some overhead costs. What I would say is, generally speaking, we're going to continue to monitor activity levels and look for ways we can be more cost efficient. But we're going to make the moves that make sense for the business based on the workload and demand. But at this time, that was the only correct move to make from a location-specific perspective. But we're evaluating all options.
Got it. That's it from my side. Thank you very much, guys.
Thanks, Bhakti.
And our next question comes from Ed Wu with Ascendiant Capital. Please go ahead.
Yeah, just touching back on the prior question. So is that correct that your field operations has relatively been unaffected by the coronavirus? Relatively?
Yeah, at this stage, as you know, this is a rapidly developing process, as everybody, I think, is aware. So we are, as I mentioned, just actively monitoring our policy to make sure that we're staying up to speed with the CDC recommendations. Of top priority to us is the safety of our employees and the folks and customers we work with. And so we're taking all necessary precautions. At this stage, we are still operating across all of our locations. And as I mentioned, we're monitoring customer activity and staying in close contact with them to the extent that changes. and we'll just respond accordingly.
Great. And then my question is, I know you talked a little bit about, obviously the oil outlook is, pretty grim right now, but, what are you hearing from, your customers? And it seems like people are predicting, or at least acting like this is going to, these $20 barrel oil is going to be this for the long haul. Is that what your customers are hearing as well?
Yeah, I don't think anybody knows for sure. What I would say is what we're hearing from most of our customers is that to expect a major drop-off in drilling and completions activity, but that the production-related work, our hot oiling and acidizing services, there'll be continued demand for that. I expect some of our customers are going to ask us to sharpen our pencil, but from the feedback we've been receiving, we've been told to prepare to continue the production-related services. I think for these E&Ps, as they're laying down their drilling completion rigs, even at these lower price points, maximizing the production out of the producing wells is going to be important for them. So, it's impossible for us or anybody to know exactly, what's going to transpire here in the weeks and months and quarters ahead. My sense is that we'll have sustained demand for the production services, and we hope to see some rationality come back to the market as we exit third quarter and head back into fourth quarter, where completions activity becomes important to us again for the frac heating services. But we're going to be proactive and continue to manage the company and our cost structure to handle whatever's thrown our direction to the best of our ability. So we're going to be very proactive. We're in constant communication with our customers and our employees and are actively managing the situation.
Great. And then the last question I have is just on the competitive landscape. Obviously, there's, a little bit of turmoil. What are you seeing from the competitors? Are you seeing anybody, you think maybe the competitive landscape will get easier as people start, going out of business, or what do you see out there?
Well, I think it's tough for everybody. As I had mentioned in the prepared remarks, we took additional market share here heading into this heating season, in addition to the market share that we picked up from the Adler acquisition. And so I know we've placed some additional pressures on our competition in our core heating markets. We've continued to take market share in Texas as well, as we've grown that market consistently year over year. I think this is going to be difficult for everybody. I'd prefer not to comment specifically on what we're seeing with our competitors, but it's my sense that the competitive landscape could be improved for us as we move forward. I mean, the reality is an environment like this, there are going to be some casualties, and we're aware of some folks needing to pull up stakes, and we're taking advantage of that where we can. We've got the equipment to do that. We've got the operators to do that. And as part of the decision to redeploy some assets out of Oklahoma to other basins where we've got work and can put those units immediately into action. So I think it's going to be to our advantage as it relates to a competitive situation.
Great. Well, thank you and good luck.
Thanks, Ed. Appreciate the questions.
And as a reminder, ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad. And we'll pause for just a moment. And I'm showing no further questions at this time, so I'll turn it back over to Ian and Margie for any closing.
Thank you. And as always, we appreciate everybody's time and attention on the call today. We look forward to talking again following the close of our first quarter. Have a nice afternoon. I hope everybody stays healthy and safe.
And that does conclude today's teleconference. We appreciate your participation. You may disconnect your lines at this time and have a great day.